Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here to explain you what could be the scenario with Federal Reserve interest rate cuts. I'm going to share with you my analysis on macroeconomical fundamentals perspective, and also by the end of the video the technical analysis on four main assets, which is futures on S&P 500, futures on Nasdaq 100, and dollar index, euro dollar, and finally, one of the last clue to understand what is going on behind the curtains on Federal Reserve is the US Treasury bond and the movement we have been experiencing the last few days, regardless the interest rate cuts. Before we go into the topic, let me remind you, if you are not subscribed to this channel, you should, because we give you updates every week. Click on the subscription button and also click on the bell to receive notifications anytime we update new topics, new videos, completely free to share with you from London ATFX. Let's go to the topics now. I want to share with you the fundamental perspective for all the dilemma that Federal Reserve is facing. We got three factors, three topics. One of them is the labor market, the second one is the inflation, and the third one is the growth rate of US economy. If we take a look on the first one, labor market is the last numbers, the unemployment rate in the United States rise to 4.4%. This is one of the reasons the Federal Reserve estimate that they should cut the interest rates. From an inflation perspective, we got the last PCE inflation, which is the favorite parameter from Federal Reserve to measure inflation, is 3% by average. So it's 2.7, 2.8, 2.9, 3, 3.1, 2.9, 2.8. The last months, the last year, around 3% for almost 2 years. And therefore is about the expectations, about the top target 2%, and therefore they should not cut the interest rates in this case, but still they did last time. And in terms of growth rate, we are between 2 to 2.8% growth rate of US economy. That's amazing. The last number is 2.8% annualized growth rate for US economy, and even the last quarter Q3 it was giving us a 3.8% growth rate for US economy. The economy is growing, there is no recession officially, the numbers are good. So the next question is why we need to cut the interest rates in an economy that is growing. As you can see, we have three factors, three parameters, and two of them are not clearly a yes in terms of resolving the question of should Federal Reserve cut the interest rates? The answer should be no in this case, following the macroeconomical data and the main economic policy manuals. The Dobbs case cut to protect employment. That's the only reason they want to cut the interest rate, just in case to protect the labor market. But still, 4.4% is relatively low unemployment rate. And if we follow the economic books and the manuals, it should be between 4 to 6%, what we consider a healthy unemployment rate in a healthy economy. So therefore, again, it's not a dramatic case, and that's the only reason that they use to justify the interest rate cuts. The transitory inflation should be actually a warning to do not cut the interest rates, because we don't know what could come in. Even the Donald Trump tariffs and the trade war with China could cause inflation in the United States. It didn't happen so far, but it could, and Federal Reserve has been mentioned since the beginning of this year. And the third, approaching to neutral territory. Only gods know where is the neutral interest rates. It's a kind of mystery. We don't know if it could be 3.75%, 3%, 3.25%. Who knows what is the interest rate that cause neutrality. Neutrality means the interest rate that is not causing depression in the economy, but neither feeding the inflation. Right? Now, Hoy's case, the more critical opinion on this is inflation remains high. As I mentioned before, the growth rate is good, is strong, 2.8% annually estimation, and extraordinary commit discord. This is the point. We have seen at least one of the members vote for not even 25 but 50 basic points cut, and we also have seen one of the members of Federal Reserve voting for keep on hold the interest rates. So there is a division on the Federal Reserve. At least we got one member voting for do not cut the interest rates, and one to cut even 50 basic points. So we don't have unity on the vision of what's going on for the monetary policy perspective. And this is a very important point or topic, right? Because that could bring you surprises. Go into the charts, go into the technical analysis. As you can see, this is the S&P 500 futures, and we got a double top. Now, this is my personal view on what is going on. I believe the perception of the interest rate cut, by the way, we just jump over one slide. Let me go back because this is a very important one. I want to show you what is the estimation of the market at 10 of December. 89.4% of the traders believe the cut's going to happen, 25 basic points, and the interest rate's going to stay between 3.50 to 3.75. Only 10.6% believe the interest rate's going to keep on hold. Now, saying that, if that's the expectation of the market, and that's what the traders believe, we have a double top on SP 500 futures. We have seen how the last 2-3 weeks the market has been rising, assuming that the interest rate cuts are happening. Therefore, if tomorrow the interest rate cuts happen, if Federal Reserve cut the interest rates, obviously, I believe this is not going to change too much the market perception because the market is already discounted the interest rate cuts. What can only change the picture here on this chart is if the Federal Reserve is doing exactly the opposite that we are considering right now, which means they keep the interest rate cuts. That's why I believe in this case, we could see that there is not enough power with the current expectations to break out the resistance of 7,930 points on SP 500 futures, and therefore we could face, actually in this case, risk-reward ratio is given to me high risk of any change on the plans. If the plans are keep going, best case scenario is going to find resistance at this level. Worst case scenario is going to move the market really strongly back to the supports to test those levels. So this, in my opinion, makes sense. I will keep on hold or even short before the interest rate cuts. Now, going to the other asset, which is Nasdaq 100, we got something similar, even weaker than SP 500, as you can see on the chart. It's not even causing a double top. It's less than that, and even could be described as a kind of bearish figure, especially if by any chance the Federal Reserve disappoint the Wall Street and the markets and the traders, and the price is moving back. We're gonna see probably a shoulder, head, shoulder on the chart, potentially causing a strong, worse bearish movements, right? Now, index, dollar index, and SP 500. And euro dollar. We got the dollar index has been rising for the last couple of weeks, regardless. The interest rate cuts expectation has been rising. Dollar should be getting weaker, not rising. If the dollar is rising, it's because the interest rate cuts expectations are too inflate. Now, if we take a look on euro dollar, we also can see what could be considered, again, a potential bearish figure pushing the market down or dropping the euro against the dollar, if by any chance, again, the Federal Reserve is not cutting the interest rates, right? And the last chart, which is very interesting and also important, is the 10 years Treasury bond of United States. The yields only rise when we are not expecting interest rate cuts. And that's exactly what happened for the last 2 weeks in 10 years Treasury bond. This should not be happening unless the traders on fixed income doesn't believe that the interest rate cut is going to happen, or in middle term, because this is 10 years. Maybe it's not happened for the last 2 or 3 months, right? That's all. I hope you enjoy this report. I'm trying to be quick but precise on the answers. And hopefully I'm going to see you in the coming ones. Take care. Give me a thumb up and see you in the next. Bye-bye.